having an eminent person and trainer. The today's topic, which is fundamental analysis with case study, Dr. V. Aditya Srinivas, sir. And currently, he's having 15 years of corporate experience in the corporate sector. And currently, he's working as a Chief Operating Officer in BSc and also a Chief Economist of Bombay Stock Exchange Broker Forum since 2013. And I would like to call Dr. Aditya Srinivas, sir, to continue this particular session. Over to you, sir.
Yes, sir. Just give me 1 second. I'm just setting my PPT. Just give me 1 second.
Yes, sir. Yes, no problem.
Just 1 second, sir.
Yes, sir. No problem.
Yes, friends, a very good afternoon to all of you. Welcome you all for today's particular session. Today, friends, the topic is fundamental analysis, and it's a very, very important topic because it basically aims to identify good companies for long-term investment. Remember, friends, the whole objective of fundamental analysis is to identify good companies for investment. But one has to keep it in mind that meaning of fundamental analysis is just not restricted to find out good companies, but at the same time, it also involves three important aspects of analysis like economic analysis, industry analysis, and company analysis. See, the whole logic is that group of companies make industry and group of industries make economy. So all the three are basically integrated to each other, and that is why fundamental analysis is also called as EIC analysis, economy, industry, and company analysis. Now, these are the important aspects what we have to find out in company analysis. For example, in case of in case of economic analysis, these are all vital macroeconomic parameters. The logic is that if the economic condition is good, then only capital will come in. And here factors like GDP growth, inflation, interest rate, exchange rate, current account deficit, fiscal deficit, index of industrial production. See, these are all main macroeconomic variables which are very, very critical and vital. So this particular angle is very important. Remember, friends, that if basically fundamental analysis or this economic analysis is strong, then only, friends, large number of investors or money will come into the market. And because ultimately it is the fundamental which plays a very, very critical and a vital role. So that particular aspect is very, very critical and important. Here we will be analyzing each of these macro variables in detail because especially in the current scenario, the macroeconomic variable of the world economy is weak. Then we will be doing industry analysis, whereby if you see post-COVID, different industries have been reacting in different ways. Some sectors have performed very well, and there are certain sectors which are still struggling. So here we will be trying to understand two important sectors like banking sector and IT sector, because both of them finally are the backbone for any economy to grow. See, without banks, no economy can grow, and without IT sector, the day doesn't start. Today, computers and technology have become the part and parcel. So IT sector is something very, very important, and banking sector is vital. So these two sectors we will try to understand in detail. And finally, friends, we have something known as a company analysis, whereby there are certain important variables which you have to analyze before you actually buy a stock. For example, gross profit, net profit, operating profit, then debt equity ratio, price earning ratio, which is a very, very important valuation ratio. So before you buy a particular share, we will also try to identify these important these important company fundamentals, so that finally when you buy a share, you have not committed a mistake. Remember, friends, that buying a stock is very important, because if the stock is fundamentally sound, the probability of the stock price rising is always on the higher side. So that is why these factors have to be considered in detail. Now, Let us start with economic analysis. See, the first and the foremost factor in economic analysis is the GDP growth. Remember, friends, GDP growth is the main parameter because it shows the economic progress made by a country in 1 year. That is something very, very vital and important. And this data is released by the government every 3 months. Remember, friends, this data plays a very, very critical and a vital role because GDP is a one-line indicator of the company's economic situation. So if GDP growth is rising, if this data is rising, you will find more foreign capital coming in and stock market rising. On the other hand, if basically this data is low or weak, in that case, the institutional investment of FIIs and mutual funds would definitely go down because it's an indicator that economy is not in a good situation. Currently, if you see as per IMF and World Bank, the GDP of the world economy tends to be at around 2.8 to 2.9% as compared to basically India, friends, which is primarily was having 6.3% GDP growth rate in Q2, and right now it has come down to 4.4%. Remember, friends, that right now the whole world economy is facing difficult times because US and Europe, the two major, what we can say, contributors inflation and interest rate. Here, friends, inflation is an independent variable, interest rate is a dependent variable. So basically, both the variables have to be considered in together. Here you will find that if inflation rises, then RBI is forced to increase interest rate. And if interest rate rises beyond a point, obviously it slows down the economy because demand and consumption in the economy will go down. So inflation and interest rate both play a very, very critical and a vital role. Right now, friends, if you see, world over inflation data has gone up. US was facing 40-year high inflation, UK was facing 30-year high inflation, and that is why their central banks, that is the US Federal Reserve, has increased interest rates to 5%, and even Bank of England increased interest rates to 4%, which now is causing difficulty because at such a high level of interest rate, there is a huge probability that large number of people may default there. And that is what is causing trouble at the global level. That is why, friends, inflation and interest rate both primarily go hand in hand. Currently, always remember one thumb rule that inflation and interest rate will have inverse relationship with stock market also and with GDP also. The reason is that if interest rates are high, why would one invest in stock market when FDs or corporate deposits are giving you 7 to 8% return? So that is something very critical and vital, which one has to keep it in mind. Second is inflation. Second is that when interest rates are high, friends, obviously your EMI for housing loan, car loan, capital goods loan, everything goes up. So when all kinds of EMI goes up, even that puts a pressure on the economy, and that primarily creates a problem. Because if inflation and interest rates are high, obviously the demand and consumption pattern in the economy will go down. Then comes exchange rate. Exchange rate, friends, is a very important macroeconomic variable, especially for India, because we import huge amount of crude oil. So exchange rate shows the rupee dollar equation, and we are aware that unfortunately rupee has been depreciating. In fact, in 2023, $1 was around 82 rupees. So that has put pressure on our balance of payment also and on current account deficit also. The logic is very simple, friends, that if the currency is appreciating, that means if rupee becomes more strong, it's an indicator that economy is doing well and basically foreign inflows are coming in. On the other hand, if the rupee keeps on depreciating, it means economy is weak and there are foreign outflows taking place. So that is why, friends, exchange rate plays a very, very critical and a vital role. Remember, friends, that RBI takes into account the total inflow and outflow of foreign exchange before finally deciding the rupee dollar equation. Then if we talk of current account deficit, see, current account deficit is the difference between exports and imports. So basically speaking, if the imports are more than exports, then it is called as current account deficit. And if exports are more, we call it as surplus. See, as far as India is concerned, friends, we typically always have a current account deficit. The logic is very simple because of crude oil and gold. See, these two things we import in a huge quantity. Crude oil, we are importing 77% of the total crude oil requirement we import. And that primarily is the root cause. And we are aware, friends, that during Russia-Ukraine war, basically crude oil had gone to $130 per barrel. And because of that, in India, petrol and diesel was above 100 rupees. And that put a lot of pressure on the economic scenario. As inflation had gone up, and finally, because inflation went up, basically interest rates also went up. And that basically created a huge pressure on the overall economic situation. Another important matter in current account deficit is basically gold. See, we are consuming gold more than any other country. In fact, India is the second largest importer of gold in the world, and our households have 25,000 tons of gold. So obviously, friends, gold also plays a very, very important and a major role when it comes to current account deficit concept. So this is again something which basically creates a problem. Then if we talk of fiscal deficit, see, fiscal deficit is the difference between government's income and government's expenditure. Remember, friends, government's income and government's expenditure is very, very vital indicator because it gives you a clear-cut idea that how things are going on. Remember, friends, that government income is the taxes paid by people and corporates. So that is what we pay to the government, and from that, government does all the expenditure like social issue, health, defense, and other things. So here one has to keep it in mind that if fiscal deficit keeps on rising, then it's a clear indicator that government is inefficient to use public money. So that particular factor is very vital. And currently, friends, fiscal deficit is at 6.4% of GDP. Now, internationally, this ratio has to be around 3 to 3.5%. But the point is that it is at 6.4%. The main reason is that globally also there have been problems. And during COVID-19, government had to come out with an economic package of basically 20 lakh crore rupees. So because of that, friends, our fiscal deficit drastically went up. So that is something one has to keep it in mind. Nevertheless, with the economy now improving and the way GST is crossing 1.5 lakh crore rupees, the overall situation is relatively on a positive side, and soon our fiscal deficit would be below around 3%. Index of industrial production, another important macroeconomic variable which shows demand in the what we can say demand in the manufacturing side. So higher the index, the better it is, friends. This is the same logic. If the index is high, it means there is more demand in the manufacturing segment, and if the index is low, we say that manufacturing demand is going down. Friends, after Make in India concept has been launched very heavily by the government, and we are trying to make a lot of things locally, that has really helped basically to improve our manufacturing, and overall things are in a better situation. So this is also an important indicator. In fact, yesterday only this data had come, and currently the IIP index is at around 5.3% from earlier 4.7%. So slowly, gradually, even the manufacturing is improving. Now, two things here. See, economic analysis. Why, friends, one has to do economic analysis? The logic is very clear, friends, that when you do economic analysis, it is very, very vital and important, because if economic analysis is done and macroeconomic variables are in good shape, then only more capital will come into the system. And India needs capital because we are a labor-intensive economy. So we have large amount of labor force. But how do we deploy them? Unless we have capital, we cannot use that, or we cannot productively deploy the labor. Hence, importance of economic analysis. Remember, friends, if the macroeconomic variable is strong, then only more foreign capital will come in. Now, once we have done macroeconomic analysis, the second vital aspect is industry analysis. Industry analysis is very important because it gives you an idea that which particular sector is basically going to perform. So here two sectors we will be primarily trying to take. One is a banking sector, one is an IT sector. See, if we talk of banking sector, friends, then banking sector before some years had huge problems related to NPAs. In fact, in 2012, the gross NPA was at 1.86 lakh crore rupees. In 2016, it was at 4 lakh crore, and in 2020, it was at 9 lakh crore rupees. So this particular point, one has to keep it in mind. But after the formation of NCLT, National Company Law Tribunal, the NPAs have drastically gone down, and today banking sector stocks are very important and they are carrying a lot of valuation. So that is why banking sector stock should be there in your portfolio because they account for 40% weightage in BSE Sensex. Here, if you see, friends, banking sector, no economy can grow without active contribution of banks because finally they lend to the individuals also and they also lend to the government as well as to the corporates also. Here, it is very important to understand, friends, that banking sector will always be the backbone. And for a country like India, if we want to really grow from a $3 trillion economy to a 5 trillion, 7 trillion, it is very vital that banking sector is very strong and robust. In fact, you can very well understand that the global financial crisis which had come in USA in 2008 was because of failure of banks only. So in any case, banks play a very, very critical role when it comes to economic growth. Then if we talk of IT sector, see IT sector basically you will always see is a very vital sector. Technology today plays a very critical and an important role. And that is why IT sector is something very important. Here we have to keep it in mind that US markets play a very critical role for Indian IT sector because we get 80% revenue in dollar terms. Here currently if you see our IT companies are totally basically what we can say are zero debt equity companies. So they don't have any kind of loan. And that basically makes a thing very, very positive. Remember, friends, IT sector is very important because our companies have strong cash flow, zero debt equity ratio. And that is why you can see that currently even the US administration is giving a lot of importance to Indian IT sector companies. And our companies like Wipro, Infosys, TCS have really created huge wealth for our domestic investors also. So that is why IT sector should also be there in your portfolio. Plus, you will agree that during COVID-19, the only this sector, only because of IT, whatever little work was happening at the global level was happening only because of information technology, and hence this sector is very important. Finally, friends, we come to the analysis of company part, that what factors you should see before you finally buy a stock. Now here, the first and the foremost important factor which you should always try to figure out is basically gross profit. Always remember, friends, that gross profit is very important because it means your revenue, sales revenue. See, if sales revenue is rising, that means basically at least the product is getting sold and market has accepted that product. If gross profit is not rising only, it's a clear indicator that either the product has failed or we are targeting a wrong market. For example, if you see Tata Nano, the car just could not be sold because there was no sales revenue which was taking place. So remember, friends, gross profit is very critical and important. Second is net profit. See, net profit is nothing but opportunity cost of capital. Here it is important to note that opportunity cost of capital is very vital. So if net profit is not rising, then FII and mutual funds will not buy the shares. Hence, net profit is very, very critical and vital. Remember, friends, gross profit and net profit both should be rising. Then only you can finally buy a particular stock. Third is operating profit. See, operating profit is nothing but the free cash flow that comes from core business activity. That is called as operating profit. Remember, friends, DLF and Unitech had negative operating cash flow, and that is why those two stocks were bleeding continuously. Operating profit means that if the operations of the company are not positive or basically not generating free cash, then how much long the company will survive. So that basically creates a problem. Hence, operating profit is very, very vital and important. And finally, friends, earnings per share. See, earnings per share, the formula itself is net profit divided by total number of shares. So if the EPS is not rising, it's a clear indicator that there is some problem in the company. And that is why, friends, rising EPS is very, very critical and important. Remember, friends, that if EPS is rising, then only FII and mutual funds will buy the shares. So that particular aspect we have to keep it in mind. Then comes, friends, price earning ratio. See, price earning ratio is a valuation ratio, friends, and valuation is an art, not a science. So basically, remember one thing, that valuation is very critical because it depends upon the investor what value he sees in the company. Now, as far as PE ratio is concerned, friends, there are two wrong concepts about this ratio. Lower P is good, higher P is bad. Actually, if you see, friends, basically PE ratio depends upon what we can say. PE ratio is depends upon the sector. See, if the sector has high growth, obviously it will have high PE ratio. If the sector has low growth, 1 minute, no, friends. See, if the sector has low growth, obviously it will tend to have a lower PE ratio. Now, for example, sectors like IT, media, telecom, private sector banks, fintech companies, biotechnology. See, these are those sectors where overnight growth is possible, sudden growth is possible. So that is why you need to have higher PE ratio. On the other hand, sectors like steel, cement, aluminium, these are all cyclical areas where the growth is always lesser, because in these areas you cannot do something overnight. So obviously the growth in these sectors is relatively less. So that is why, friends, both these sectors, one has to keep it in mind. Finally, if we talk of debt equity ratio, see, debt equity ratio is the most important ratio after global financial crisis of 2008. Here, friends, one has to keep it in mind that if this ratio is on the lower side, obviously this is better. Remember, friends, lower debt equity ratio is very, very vital and important. The reason is that if the debt equity ratio is low, the company will not come under pressure to pay interest, and basically the free cash of the company can be utilized for rewarding shareholders. See, we are very well aware that companies like Kingfisher died out because it took 7,000 crore rupees of loan. Jet Airways died, it took 8,000 crore rupees of loan. Then Reliance Communication, 800 rupee stock became 1 rupee because it had taken a loan of 39,000 crore. So remember, friends, that the debt equity ratio, something is very, very vital. Today, if you see, investors are looking for those companies which have a zero debt equity ratio, so that there is no pressure on the company and when the company can perform well. Remember, friends, lower the debt equity ratio, the better it is. Dividend payout ratio, if you see, friends, the dividend payout ratio is again very vital and important because it shows the higher amount of dividend paid by the company. It's a clear indicator that the company is fundamentally more sound. So that is why dividend payout is very important. Remember, friends, that higher dividend payout is very, very vital, and that is why dividend payout ratio is something we need to keep it in mind. Remember, friends, that a company which regularly pays dividend is automatically fundamentally sound, because here the cash is actually going out of the company, and that is why dividend payout ratio plays a vital role. Then comes liquidity ratio. See, liquidity ratio basically refers to how much liquid assets are there with the company. So again, higher the ratio, the better it is. Here, friends, we have to keep one thing in mind, that if your liquidity ratio is on the higher side, then company can manage its short-term payment obligations easily. Then if we talk of order book, see, order book basically shows you the amount of work or the order company has in hand. So higher the ratio, the better it is. See, basically more work the company has, more future cash flow it will be able to generate, and that is more suitable for the company. So that is why, friends, order book tends to play a very critical and a vital role. And finally, friends, we have something known as a corporate governance. Remember, friends, corporate governance means management honesty. Management honesty is very vital, because a company which is honest enough will really be able to make more amount of valuation in the long term, because people are honest enough. And that is why, friends, in the long term, those companies which follow ethical business practices will always survive. Finally, friends, the conclusion is that fundamental analysis is very vital, and it is something we need to keep it in mind for long-term investing. But here, when you are doing long-term investing by finding good companies of investment, one has to do industry and economic analysis also, because that primarily gives you an overall view that whether things are in proper shape or not. Remember, friends, that stock market will give you good return only if economy is in good state, because finally economy is an independent variable, stock market is a dependent variable. So with this, friends, I conclude my part, and now we can go for question answer session. So please feel free to put your question in the chat box. I'll be more than happy to read and answer your questions. Yes, friends. Yes, friends. Any doubt, difficulty, any particular question is there, please feel free to ask. Don't hesitate.
Sir, might be
Yes.
might be like students understand all the concept very well.
Thank you
Yes.
so much, sir.
So thank you, sir. Sir, on the behalf of S.S.T College, I would like to thank you for giving us some valuable topics and valuable lessons about the economic analysis, industry analysis, and company analysis. Thank you so much, sir, for this particular wonderful session.
Thank you.
Yeah.